And welcome back, listeners. Thank you for joining us for another episode of the Invisible Threat Podcast. And as is normal and becoming very normal, coming in from Vegas area, my co-host, esteemed Dr. Matt Eby, and his co-author of The Invisible Threat, Joanne Eby. Matt, Joanne, how are you guys doing today?
Doing great. It's still beautiful weather out here in Las Vegas area. And we were out on a really long hike yesterday. I think we overdid it a little bit. It was a hike that we used to live out here, and it was a hike that we've done a few times, and we haven't done it in a few years, but it's almost 7 miles long. And yeah, by the end of it, we were going like, wow, this used to be fairly easy. No, it wasn't as easy as we remembered. So yeah, it was a long duration of a hike.
But we made it.
I'm obviously here in Scottsdale, Phoenix area. We were overcast basically all weekend long. I don't know if you were sort of that way too in Vegas, but it was nice because I was out preparing my son, aspiring golfer Carter Samuel, for his first attempt at qualifying for the U.S. Amateur coming up here at the end of the month. And it was nice out in Phoenix because we were out there for 7 hours on Saturday, 7 hours on Sunday. And that little overcast was kind of nice. So it wasn't as bad as it could have been this time of year out here in Phoenix.
Yeah, it was cool yesterday.
Yeah.
Which is why we made the attempts.
Yeah.
Yeah. Awesome. Well, hey, listeners, again, thank you so much for joining us for another episode. So I want to go ahead and jump right on into it. And, last episode, we discussed something that, frankly, for me, was a little unsettling. We explored the possibility that traditional risk assessments may not actually be failing. They may be doing exactly what they were designed to do. So the challenge, according to the two of you, may be that they were never designed to see fiduciary judgment in the first place. And if fiduciary judgment is where fiduciary risk actually forms, then that creates a pretty significant problem, I would say. Because it means the most important risk in the fiduciary business may not appear on the risk assessment at all. So today, I want to pick up where we left off. If traditional risk assessments weren't designed to see fiduciary judgment, what exactly is fiduciary risk? And Joanne, let me start with you. How does the industry typically define fiduciary risk?
Well, the interesting thing is that most organizations don't formally define it. They use the term, certainly. They reference it, they report on it. But if you ask 10 fiduciary organizations to define fiduciary risk, you'll likely hear 10 different answers. Some will describe it as compliance risk, others as legal risk. Others will describe it as reputational risk, and many will describe it as operational risk. And organizations often simply inherit whatever definition their regulator, consultant, auditor, or risk department uses and has used in the past.
That's actually true. I've heard all those definitions, and I've probably used some of them myself, actually.
Yeah, Carter, most of us have. And that's exactly why I think this conversation matters. Because before we can manage fiduciary risk, before we can assess fiduciary risk, before we can monitor it, we probably ought to agree on exactly what it is.
Yeah, well, okay. I mean, that seems reasonable, logical, right? So where do we start?
Yeah, so let's start with something simple. Let's compare fiduciary risk to every other major risk category that organizations commonly manage. Because I think that's where the problem begins to reveal itself.
All right. Well, I'm on the edge of my seat. Walk us through that.
Let's start with credit risk. Credit risk is the likelihood that a borrower fails to repay an obligation. That's a relatively straightforward risk in the industry.
Yeah, like a loan doesn't perform, right? Something like that.
Exactly. Market risk is the possibility that asset values will move adversely. For example, interest rates will move, equity markets will decline, currency values will change. Again, it is a fairly straightforward risk.
Yeah, there's like ebb and flows, right? It's this balancing act that happens. So, well, let's talk a little bit about what about operational risk?
Well, operational risk, some years ago, it was formally defined, and it is generally defined as the risk of loss resulting from failed processes, failed systems, failed controls, failed people, or external events like technology failures, processing errors, fraud, business continuity risks, vendor failures, things like that.
So, fair to say then, each of those categories has a relatively clear definition.
That's correct. And notice something important. Each of those categories focuses on an exposure, something that can be observed, something measurable, something that can be monitored, and it's something that can fail.
And that's the important part. Credit risk is the risk of default. Market risk is the risk that market pricing moves negatively. Operational risk is the risk that a process fails. Liquidity risk is the risk that funding becomes unavailable. Every major risk category describes a threat to an asset or a process, the institution, or a financial condition.
Okay, all right. Well, I mean that all seems obvious. I've had, extensive experience in the insurance world, as you both know, right? Coverage is designed to kick in when the risk, right, the adverse event that the insurance is meant to cover. I mean, we all have car insurance, right? So same kind of an idea, as well as home insurance. So if the house is damaged by a fire, the insurance coverage will kick in.
Yeah, exactly right. Now let's ask the same question about fiduciary risk. What exactly is failing?
Okay, well, so is it the trust officer? Is it the process? Is it the decision? The institution? I'm not quite sure here. What, I mean, that maybe that's a loaded question. I'm, cleared up for all of us as we're listening.
Yeah, that's exactly the issue, right? Notice how quickly the answer becomes less clear than in all of those other risks.
Because fiduciary work is fundamentally different. A fiduciary is not managing a loan, not managing a market, they're not managing a process. The fiduciary is exercising discretion, interpreting information, balancing competing interests. They're making judgments under conditions of uncertainty.
Which means the thing being managed is different.
Exactly.
And that's where I think the trust industry has inherited a flawed assumption. For decades, we've treated fiduciary risk as though it belongs in the same family as operational risk. But let me ask a question. What if it doesn't belong in the same family as operational risk?
Matt, I'm going to go out on a bit of a limb here and say that's a pretty big claim.
I know, but let's test it. Suppose the trust officer receives a discretionary distribution request. They follow policy. They review the governing document. They gather information. They document their analysis. They present to committee. They obtain approval. And every required control functions exactly as intended.
Okay, check.
Did fiduciary risk disappear?
Not necessarily.
Why not?
Well, because the judgment exercised could still be challenged.
Exactly. Now we're getting somewhere. The control system worked exactly as designed. The process was flawless. The governance system worked. The documentation worked. But none of those things tells us whether the judgment itself was sound. or even whether the discretionary decision can be successfully challenged down the road.
And Matt, that's an important distinction. Controls can support judgment, they can inform judgment, and they can guide in documenting judgment appropriately. But controls cannot replace judgment.
So, Matt and or Joanne, you're suggesting fiduciary risk survives even when every control works as it was intended.
Because fiduciary risk does not begin with those controls, it begins with the judgment itself. The control environment exists to support, monitor, and document fiduciary decision making, just like Joanne just said. But the risk itself originates much earlier. It originates when a fiduciary starts interpreting facts, balancing competing considerations, and deciding what should be done. Remember, Lindsay said, what can be done versus should we do it? Essentially, fiduciary risk begins the moment the trust company accepts the appointment as fiduciary, because fiduciary discretion exists precisely where reasonable people can disagree. And where reasonable people can disagree, judgment becomes necessary.
That's really interesting. So the risk isn't necessarily that somebody violated policy or even ignored the procedure, right? The risk may be that somebody interpreted a situation poorly,
or incompletely, or defensively, or emotionally, or through assumptions they never realized they were making.
And that's why fiduciary work is fundamentally different from process administration. The most significant fiduciary activities involve interpretation of documents, interpretation of intent, interpretation of fairness, interpretation of competing interests, interpretation of risk, interpretation of family dynamics, and interpretation of the circumstances.
Yeah, and interpretation isn't something in a control, right, can fully evaluate.
Now let's take the next step. What if fiduciary risk isn't primarily the risk of a bad outcome? What if fiduciary risk is actually the risk that fiduciary judgment becomes distorted?
Distorted. Wait, say that again.
Yeah, so here's the basis of our definition. What if fiduciary risk is the risk that fiduciary judgment becomes distorted? Not the outcome, the judgment process itself.
For those of you listening, that's a very different definition.
It is, because now we're focusing on the formation of judgment rather than the result or the outcome of the judgment.
Think about it. Two trust officers can reach very different conclusions. Both may be acting in good faith. Both may be competent. Both may have followed procedure, but one judgment process may be stronger than the other. One may be more balanced. One may be more complete. One may be more aware of competing considerations. Therefore, one may be less distorted.
So the risk exists even before the decision is made.
That's exactly right. And that's the shift. Most traditional risk frameworks focus on outcomes. We're suggesting fiduciary risk may originate much earlier, while judgment is still forming.
Before the committee puts anything to a vote, before the distribution is made, before the documentation is gathered, before the examiners come in to examine the organization, before any litigation that might occur, before the outcome of the judgment.
Now, that actually explains something that I've seen in the past. I've seen situations where a decision worked out well even though the reasoning behind it was weak, right? At best. And I've seen situations where a well-reasoned decision produced an unhappy outcome.
Yeah, exactly. Outcomes can mislead us. Good outcomes don't always indicate good judgment. Bad outcomes don't always indicate poor judgment. The quality of the judgment process matters independently of the result.
If that's true, where should organizations that are like making these judgments, where should they be looking?
That's the question. Because once you define fiduciary risk as distortion of judgment, the conversation changes completely. The question is no longer what controls failed. The question becomes what influenced the formation of judgment.
And that's where things become much more complicated. Because now we're talking about human interpretation, experience, assumptions, professional identity, institutional culture, emotional dynamics, governance structures, competing priorities, and overall risk tolerance.
Well, I'm just going to say that sounds much harder to measure.
It's hard to measure, but that difficulty doesn't make it less important. In fact, it may make it more important because organizations often devote enormous resources to monitoring things that are relatively easy to observe, while paying much less attention to the processes that actually generate discretionary decisions.
Let me push back just a little bit here. If fiduciary risk is really judgment risk, doesn't that mean every fiduciary decision contains risk?
I think the answer is yes. And that's not a flaw. That's the nature of fiduciary work. Discretion exists because certainty does not. If certainty existed, judgment would be unnecessary.
And that's an important point. The fiduciary profession was not created to administer certainty. It was created to navigate ambiguity.
Yeah, that's a great point. And ambiguity, right, creates the need for judgment.
Exactly.
Which leads us to what I think may be the industry's missing risk category. Not operational risk, not compliance risk, not legal risk, not reputational risk. Judgment risk. The possibility that the process by which fiduciary judgment forms becomes distorted.
Let me take that in for just a second, because this is, for me, as I'm thinking through the years in the financial services business, right? That's a pretty significant departure from how most organizations, and I've been parts of a lot of them, think about fiduciary risk.
I agree. But I think it's a necessary departure, because if fiduciary risk is actually judgment risk, then we have to begin asking different questions. Not simply, did the process work? Did the control work? Did the documentation exist? Did the committee approve it? But also, how was the judgment formed? What assumptions influenced it? What forces shaped the judgment? What pressures affected the exercise of discretion? What factors distorted that exercise at that point?
And once you start asking those questions, you begin to see the fiduciary environment differently. You start to see things that traditional risk frameworks rarely capture.
Which sounds like that's where we're headed next.
You know me all too well, Carter. Because if fiduciary risk is the risk that judgment becomes distorted, the next question becomes, what distorts fiduciary judgment? And that's where things start to get really interesting.
So here's the deal, listeners. Today, we explored a simple question that turned out not to be so simple at all. What exactly is fiduciary risk, right? What is it? And maybe the answer isn't what most of us have assumed. Maybe fiduciary risk isn't primarily the risk of a failed process, or as my northern border co-author of the Invisible Threat Process would say. I always love that, by the way. I got to throw that in there because I love how Canadians say process. Anyway, maybe it isn't primarily the risk of a failed control. Maybe it isn't primarily the risk of a failed outcome. Maybe fiduciary risk begins much earlier inside the judgment process itself.
And if that's true, the future of fiduciary risk management may depend on our ability to understand how fiduciary judgment forms.
Because if judgment is where fiduciary risk originates, then understanding judgment may become the most important risk management capability fiduciary organizations develop.
And that's where we're going next. All right. So if fiduciary risk is the risk that fiduciary judgment becomes distorted, what exactly causes that distortion? We'll see you next time on The Invisible Threat. Most organizations move past these moments. We don't. And listeners, thank you so much for joining us for another incredible episode of the Invisible Threat Podcast. And as I normally say, make sure to like, share, and subscribe wherever you get your podcast. But man, you guys really have my brains rolling and thinking about all of this stuff. And our listeners, I guarantee if they're listening, they can't wait to see next week.
We can't wait to share it.
I can't wait to really dig deeper into that stuff. So, as is normal, we come on here, we share all this incredible insight from the two of you. The Invisible Threat Podcast was thought up because of that incredible book that you have. And I don't know if we ever talk about, I want to give a plug to your book. I want to talk about maybe a place where people can go and get that. You guys have that book on Amazon, don't you?
Yeah, it's certainly on Amazon. Yeah, they can also, we were just published in the FIRMA annual or the quarterly newsletter at FIRMA, Fiduciary Investment Risk Management.org. And my email's on there as well, but it's on LinkedIn. They can contact me too, and we can send them a copy of the book. If they contact me, I certainly would send them a copy of the book. So, yeah.
Awesome. Well, Joanne, thank you so much for being a part of this podcast. I know that wasn't necessarily the original idea, but I love having the two of you on here so that we can pull and extrapolate all this amazing experience out of both of your minds and your experience that you've had in this industry. And obviously your dissertation that you have, my friend, Dr. Matt Eby, thank you so much for always being on this as my co-host from the outset. So listeners, for Dr. Matt and Joanne Eby, I am Carter Wilcoxson, CEO and founder, wishing you all a wonderful day, and we will definitely see you next time on the Invisible Threat Podcast. Thank you, everybody.